Thank you very, very much for joining us in this edition of the India Development Debate. I'm Supriya Shrinate right here on ET Now, and we put the spotlight on what we are calling a time bomb that is ticking fast. The IL&FS turmoil has sent shockwaves across the financial market with no signs of an immediate resolution in sight. The jitters have already been felt on the last trade, with the Sensex tanking more than 800 points in the last two trading sessions. Remember, the panic was such that the Sensex fell as much as 1,500 points on Friday on liquidity concerns, with stocks of NBFCs and banks bearing the brunt. IL&FS needs truckloads of money to pay up its investors, but it is not going to be easy. With a junk rating and more than 91,000 crore rupees worth loan on its books, IL&FS needs nothing short of a miracle to pull itself out of the mess. The government has washed its hands of making it clear that being a private company, IL&FS will have to fend for itself. All eyes are now on LIC, which holds over 25% stake in the company, even as it looks to generate some of big money by divesting infra assets. The contagion from IL&FS, which many are perhaps also calling India's Lehman moment, is a big topic of discussion and debate right here on the India Development Debate this evening. Meera Sanyal, former CEO and Chairman, RBS India; Lakshmi Iyer, CIO, Fixed Income and Head Products, Kotak Mutual Fund; Somnath Mukherjee, Managing Partner, ASK Wealth Advisors; Jayan Gupta, Founder and MD of SES and former Executive Director of SEBI; and Maithili Bhusnoor Madha, Consulting Editor right here at ET Now. Thank you very much, each one of you, for sharing time and being with us on the show this evening. And Maithili, it's only fair that I begin talking to you. The IL&FS contagion has been in the markets. It has defaulted multiple times in the last 2 to 3 weeks on bonds. On Friday, we really felt the fury of what the markets could see if there were to be some sort of a contagion. But 48 hours after IL&FS was a private company, and that's what the government said, we now have regulators like RBI and SEBI, and now the finance minister categorically stating that the government will take all measures to ensure adequate liquidity is provided to NBFCs, mutual funds and the SMEs. Is there finally a recognition and acceptance of how deep the crisis could be, and that, which is why the assurance is coming in from the highest level? The question is, will this soothe and frayed nerves? Maithili.
Well, it's a little difficult to say whether it will soothe nerves, because markets, as you know, tend to be very skittish. So whenever fear overtakes the market, it tends to swing, to the extreme. But the fact is that even though IL&FS is a private company, because public sector ownership is less than 50%, so it is definitely in the private sector, the fact is that it is a systemically important non-bank finance company. That means it has implications for the safety of the entire financial system and hence for the economy itself, which is why SEBI, the RBI and the finance minister have rushed to assuage fears and say we will provide liquidity. Now, the question really is the problem in IL&FS one of insolvency or one of just lack of liquidity? So I think it's very important that we distinguish between the two, and if it is purely a case of lack of liquidity, temporary problem of liquidity, and there is no great systemic risk, then maybe the government can take one course of action. Whereas if it is a question of insolvency, then whatever the government does, it is not going to stop the problem. Because one must remember that part of the problems of IL&FS is, of course, apart from the failure of the regulator, the rating agencies, auditors, and most importantly of the board, there is also the issue of its entire exposure to the infrastructure sector. So unless whatever band-aid solution the government comes up with addresses all these multiple issues, you are not going to find a lasting solution, Supriya.
Right. So just hold that thought. I think there needs to be a larger demarcation made between, is it a liquidity crunch that's causing this problem? Is this an insolvency issue? I'll come to that in just a bit. But many people, Ms. Sanyal, are calling this IL&FS India's Lehman moment, given the contagion it can potentially spark. It has outstanding liabilities that are little under 1 lakh crore rupees. Can one afford to let IL&FS go under? And which is why perhaps the markets are feeling the tremor that they are.
Well, Supriya, I think the point is that we are at a point of weakness. There are many factors which are causing international concern. We can see that the Brent futures have crossed $80. The prices of petrol in India are, are close to or have crossed 90 rupees. The rupee is weakening. There have been further trade sanctions between China and the United States. So there are international tensions, there are local tensions. This is a point of weakness globally and locally for the economy. We're also seeing the Fed, which may hike interest rates over the next day or two. And so we are witnessing very skittish markets. Therefore, IL&FS in and of itself should not destabilize the Indian market. But given the circumstances, it could very, very well be a trigger which causes a set of domino effects. And I think the government would be very well advised to step in and take very serious measures, because as Maithili has said, IL&FS is not just another NBFC. It has major obligations to other banks, to other financial institutions. And if IL&FS goes down, the repercussions could be quite significant.
Oh, absolutely. The domino effect will have a huge toll, not just on our markets, but on our economic system. And I'll come to, those parts in just a bit. But a quick comment from you, Mr. Somnath Mukherjee. Many in the government, I mean, first they were in denial and they said, we've got nothing to do with this. This is a private company. But many in the government, in close quarters off the record, are calling it another Satyam. Now, how close to the truth is that assessment? And can the damage be controlled if there isn't a bailout?
Whether it's a Satyam or a Lehman, really Satyam was a case of fraud. Lehman was more of a systemic issue around a whole variety of other factors. Whether there's a case of fraud there or not, we wouldn't know. We don't know yet. We will probably know in the weeks and months to come if there was indeed one. Is this a Lehman moment? I think that's playing it up too much. Lehman had a swathe of other issues, including cascading exposures due to derivative structures built one on top of the other, none of which are present in IL&FS. Having said that, can this problem be resolved by ignoring it? The answer is no. It has to be tackled. And left untackled, it will have impact which are not so nice on the financial markets. And some of that in situations of crisis of confidence can result in dominoes of sorts. Therefore, the prudent policy making position would be to nip the problem in the bud and lick the problem while it's still being discovered, rather than letting it fester for some more time. So I would rather say that this is the time for policymakers across the board, capital markets as well as the central bank, to nip the problem in the bud, and something that they have seemingly started.
Okay. Hold that thought, because I'm going to get in Lakshmi here and then we'll go to Mr. Gupta for a more regulatory bird's eye view of this whole thing. And Lakshmi, IL&FS says that they need about 30,000 crore rupees to tide over the present crisis. Is that sort of a lifeline going to be enough to keep the company afloat? I mean, on its part, it says there are 16,000 crore rupees that NHAI owes it. LIC, and reports do suggest, is looking at a lifeline of 4,000 crore rupees. The question is, after its lack of total oversight, are these plans of further increasing exposure warranted at all? I mean, LIC, after all, is dealing with policyholders' money. So I think I'm asking you multiple questions, but really the question is, what sort of a lifeline will keep the company afloat, and should LIC be increasing its exposure?
So, if you look at this entire IL&FS problem, there are, and you segregate it into two parts. One is the main company, and then obviously the holdcos and its subsidiaries, or the SPVs. If you see the SPV part of it are road assets or other toll assets which are cash generating, and then there is the subsidiary, and then there is the main company. So, you have to quarantine which part of the problem, or which part is where there is an immediate problem which needs to be tackled, with a combination of capital infusion from the existing shareholders, and second, obviously a combination of immediately some sort of a bridge loan financing to tide through the near-term crisis or the liquidity crunch that they are facing. We have seen something similar in the past as a fallout of demonetization, which happened with a few microfinance companies specifically, and while they may not have had such marquee shareholders as part of their capital structure, but they did decide to take that kind of a stance. In this particular case, the magnitude of the problem is little bit much more higher, because the holdings is not only with banks, it's also with provident funds, insurance companies, mutual funds are the smaller piece in this entire pack. So I think it would be imperative to at least ascertain what kind of capital infusion would be required and what would be the contours of it. I think mindlessly putting in money is not something which anybody is suggesting, but at least work out the contours and figure out at what time frame how much is required to be able to probably tide through this immediate liquidity crunch, which probably, if left unattended, could actually morph into a much more severe solvency issue.
Okay, fair point. But let's just shift focus to what was happening at IL&FS. And I want to go to Mr. Jain Gupta on that, and then Maithili, and then Ms. Sanyal. And Mr. Gupta, IL&FS group consists of 24 direct, 135 indirect subsidiaries, 6 JVs, 4 associate companies, and bulk of the liabilities are deployed at the group companies. So I don't buy the argument that people say the parent company is doing very well, because I think for the better perception, for a better analysis and assessment, we've got to look at the group level. Now, in the last 4 years, net profit of the parent company, yes, of course, has increased from 210 crores to 450 crore. But at the group level, the net profit of 80 crore rupees in financial year 15 has actually become a loss of 209 crores in financial year 18. The liabilities rose from 68,000 crore rupees in fiscal year 15 to 99,950 crore rupees in fiscal year 18. These can't just be infrastructure bottlenecks, can they?
See, I would say these are just numbers, but what is more important is the cash. Now, I wonder what RBI has been doing and what the glorious board of directors were doing. If you look at the standalone balance sheet of IL&FS, you will find that the basic thing that you look is for the liquidity, the current ratio has been almost 0.5 last year and even this year. And if you take away from that the receivables, that is receivable from the subsidiaries, it falls further. So one thing is that it was going to happen, because as long as you were able to rob Peter to pay Paul, it was happening that you were borrowing and paying it. But all throughout the structure was different. Their current ratio, which we as a banker take one of the basic measure for liquidity, has been less than 1. So the crisis was there. The question that comes, as Maithili said, that it is a systematically important NBFC. Now, how do you deal with a systematically important NBFC as a regulator? If you have not been telling them that your current ratio is less than 1/2, which is very, very dangerous, what are you doing? And I would say that, again, I have been pointing out, if you look at all things that is happening, RBI is coming out to be a regulator which is probably causing all this thing. We have no clarity what happened in PNB.
Mr.
We
Gupta,
have no clarity
Mr.
what
Gupta,
is
may
wrong
I just
with
stop you there?
Yes Bank. We have no clarity what went wrong.
Mr. Gupta?
Yeah.
Mr. Gupta, may I stop you just there, because I have a dedicated segment on the role of the regulator and the regulatory oversight or the lack of it in just a bit. I'm coming to you in just a bit, because that's a question that I want to specifically pinpoint and get down to. But Ms. Sanyal, if I may take the questions, let the financials tell a story that the performance has deteriorated. What is most baffling is that for every organization, the senior management takes a hit. In this case, they were rewarded. Ravi Parthasarthi's total emoluments shot up by 144% in fiscal year 18 versus fiscal year 17. Hari Shankaran's total remunerations rose by 61%. Saha's increased to 7 crore annually. I mean, the performance appraisal of senior management is done by the Nomination and Remuneration Committee, and one wonders what sort of criteria were they using? I mean, the board's fortunes, the company's fortunes were plummeting, and they were rewarding senior management. They weren't even talking about restructuring the board.
Well, I think you've made a very valid point. I think certainly the board and the senior management of IL&FS do need to be held accountable. But what is more puzzling to me, Supriya, is what were the credit rating agencies doing? If you see up to August 7th of this year, IL&FS was rated as a AAA company. And this is something which is extremely puzzling because, as you can see, the financials were available for everyone to see. It is clear that, you know, a company like this, which is lending through its subsidiaries into infrastructure, needs to be assessed also at a group level. How is it that IL&FS has gone through a 4-point downgrade? It's now rated BB. It's now junk bond status. And let's understand that there is once again public money being placed on the basis of the credit rating agencies. Several mutual funds have invested in these papers. Several people are holding commercial papers. This is, I mean, when you talk of a Lehman type of moment, this is what has ominous similarity to the global financial crisis. The credit rating agencies were completely oblivious of this huge, big, you know, hidden explosive device which was lying around, and no one was able to assess. And the question that now arises, and I think that is one of the reasons for the weakness in the market, is that people are saying, what else is out there which we don't know about? We have relied on credit rating agencies, we have relied on regulators, we have relied on boards of companies, and all of them seem to have failed us.
No, absolutely. Everybody has failed. In fact, I was going to touch the point about credit rating agencies in just a bit, but I think you've rightly pointed this out. I'll come back on regulatory oversight, but Maithili, I want you to answer the question first on the board that that kept rewarding senior management. And the shareholders of IL&FS include LIC, SBI, the Central Bank of India, stalwarts like R.C. Bhargav, Michael Pinto, Sunil Mathur, Jay Tirath Rao were independent directors, and for many, many years, its shareholders include Oryx Corporation, Abu Dhabi Investment Authority, HDFC. Are you telling me they all collectively failed in their fiduciary responsibility, Maithili?
Well, it does appear to be so. They clearly didn't take their responsibility seriously enough, because no questions seem to be asked about the steady over-leveraging by IL&FS, why such huge remuneration should be paid to the top brass, and why the performance of the subsidiaries was so dismal. Because had the board played its role, they should have asked questions. But this clearly is a problem, not just with IL&FS, but as we are seeing increasingly in the case of other companies also, whether it is Satyam Computers, whether it is ICICI Bank, that when you have a CEO who has been very charismatic, who has been in the role for such a long time, he virtually captures the board and he is allowed to run the company like a personal fiefdom, which is why I come back to the point, Supriya, that I made in your program earlier also, that particularly in the case of financial companies, I think there should be a tenure beyond which the CEO's role is not renewed, because otherwise you have CEOs who really run amok and boards which are completely captive, don't raise any questions at all, and then we end in a situation like we have today in the case of IL&FS and perhaps even with ICICI Bank.
No, absolutely. I mean, whether it's Yes Bank, whether it's ICICI Bank, it raises questions on the roles of the regulator. But before I go to the regulator, Somnath Mukherjee, the question also to you is, look at what has happened. It's ironical that Mr. Mathur, who's a former chairman of LIC, has been a board member for 13 years at IL&FS, is now elevated to be the chairman. I mean, the reality is that he oversaw, his reign was the reign that oversaw the mismanagement. What business does the board have to elevate him as the chairman? I mean, he was very much there when this rot was setting in.
Yeah, so it's a fair point. I mean, the critique of the board governance of financial institutions is something that that has been around for quite some time. It's been debated. Executive compensation since the 2008 global financial crisis has also been addressed. A lot of international firms, a lot of Indian firms as well, have tried to bring executive compensation in line with performance and performances that are linked to performance of the entity, including provisions for clawback of variable bonuses and incentives paid. There has been a huge amount of movement on executive compensation since 2008. Having said that, the way some of our larger financial institutions are governed and how the boards function obviously leave a few questions, a lot of questions for the regulators to mull over and quickly find resolution to. and there's no gainsaying that.
Lakshmi Iyer, I'll come to you before I go back to Mr. Gupta, because there is a risk management committee in an NBFC like IL&FS, and that obviously plays an extremely crucial role in assessing asset liability management, credit, liquidity, market risk, capital adequacy, compliance with regulatory norms. As per annual reports, this important and critical committee of the board at IL&FS met just once. That is all that they did between 2015 to 2018. Compare that to the same committee that met 14 times at IDFC. I mean, my question is, what were they so busy doing?
No, I think, Supriya, it's a very, very valid question. See, now these kind of questions are being posed even by, the bond market participants. There is no denying that. But I'll tell you what comfort also could have been drawn, which probably overlooks some of these, things which are supposedly, commonsensical, is if you see in the history of maybe 35, 40 years, you've never seen a AAA go into a D. That's point number one. Again, I'm not indicating, therefore, that rating is, the only thing that one needs to consider. But that is one level of check that, the markets get as confidence. The second is that even if you are AAA, the market has its own uncanny ability to tell a AAA probably from a non-AAA, which is why if you see these bonds were trading at maybe 50, 70, 80 or maybe even 100 basis points higher than a AAA. But even then, that did not suggest that a AAA could be going down to as low as a BB or below investment grade. So yes, a lot of these questions that you are posing definitely comes as mysterious or very surprising, because as you rightly observed a minute back or a few minutes back, that it had such marquee board members, including the independent board of directors. So the general assumption is, as is in all board meetings, is yes, there is that level of basic due diligence that is being done, as is being done for a AAA entity. But yes, there are a lot of these questions which continue to puzzle most minds, specifically investor minds, and we definitely are looking forward to some tangible outcomes over the course of this weekend.
No, absolutely. And when those board meetings do happen, one wonders how much money is going to come in, what is going to happen, what's the call that the government is going to take. I will discuss, I think we're bashing IL&FS, but I will also discuss some of the issues that it faced in just a bit. But I think I need to get the problems and the stakeholders out of the way. And Mr. Gupta, this question is really for you because you alluded to this point earlier. RBI, I mean, IL&FS is registered under RBI, like it has been said in this program, as a systemically important non-deposit accepting core investment company. How could a situation be allowed to continue for so long? I mean, this is ratings agency failure, this is board failure, this is risk committee failure, this is nomination and remuneration committee failure. But I think most of all, this is complete lack of regulatory oversight.
See, I would say it is a failure of all levels, regulatory oversight being the supreme. It is like this, that the whole house was on a pack of cards, and when the CEO quits in July, the whole house gets down because one pack of card is missing. The issue is that how come this problem accentuated only after departure of Mr. Parthasarathy? That is one. The second important is, as somebody has said, that what were the directors doing? The issue is all directors, if you see, they are very capable. Mr. Jaitis Rao has been a city banker and he knows bank. Now, if you tell me and he says he doesn't understand what is the mismatch between the liquidity, I would be absolutely aghast. The issue is we have a system of complying in letter, not in the spirit. The board would have met 100 times in 10 years, but what they would have discussed, none of us know. Nobody wants to raise uncomfortable question. Because if you raise uncomfortable question, you may not be renewed for the next board. So the problem is that as long as my character is wrong, I can always play whatever I want to do. The other issue is very clearly, if you look at all that, when Maithili was saying, it is a systematically important institution. Now, what are the parameters on which RBI evaluates and judges and do something. Now, there is one more problem. As long as we keep on evaluating companies based on the order book syndrome, then what happens? You keep on booking order but not performing. There is no cash flow coming. You execute 10,000 crore order, 2,000 or 3,000 crore is pending, and you execute new order. So as long as we, in such companies, we do not keep a tab on the cash flow and mark every project cash flow to that project. Don't look it on the collective basis. If you look at balance sheet of IL&FS, you will find that any person who is the student of high school will find that there is going to be a problem. And that problem came because this year 30,000 crore worth of liability which were long term are maturing and they have no cash for that. So it's a failure.
Okay, just hold that thought because I think I want to shift the... I understand. Yes, it's a failure at the regulatory level, it's a failure at the board level, it's a failure at the ratings agency level. There is a systemic problem as far as this IL&FS is concerned. And I think it's reflective of how problematic the situation really is. But let me just quickly go across to Maithili. And Maithili, let's start the round with being a little kind to IL&FS, and I'll tell you why. Is it fair to compare IL&FS with any typical NBFC? Its assets are all long duration infra assets with unpredictable cash flows. You take your normal consumer or your housing NBFCs, they've got predictable cash flows, reasonable prepayments, and that low ALM mismatch. Are we being too unkind to compare IL&FS and holding it responsible for this contagion in the NBFC pack?
Well, yes, there is a problem when you're financing infrastructure, particularly with short-term deposits, and as in the case of IL&FS, it is a non-deposit taking a non-finance company. You're going to take it from the wholesale market. That means you don't taking retail deposits. Your entire funding is from the wholesale market, and these are typically short-term funds that you're taking, and you're investing in a long-term infrastructure projects which have long gestation periods. And given the problem of infrastructure in our country, very often there's, in fact, almost invariably, there's both time as well as cost overrun. So you have a huge mismatch, much more than in the case of commercial banks, because in the case of commercial banks, at least you have your savings and deposit base, some core deposits. This is perhaps inevitable in some ways, which is why the regulator, the rating agencies and the board should have been asking many more questions, should have been looking askance and finding out what is wrong, why is it that there are so many projects which are stuck. How are you going to continually finance them? Where are you going to be able to roll over? Which is why it's a colossal failure on all fronts. And as I said, even if you extend a short-term loan, some kind of liquidity support, unless you address the basic issue of how are you going to fund infrastructure, unless you have long-term sources of funds, this is an issue which will keep coming at us again and again.
Meera Sanyal, I see you nodding. So I want you to add your voice to the point that Maithili was making on the issue. Really boils down to how are we financing our infrastructure? Can long-term infra projects or can long-term infra assets be financed by, small, returns on a 10-year finance, say? And the larger question also is, are we then misjudging IL&FS? I mean, the assets are built for 30-year return on a 10-year finance. They have to refinance it every 10 years. That's their model. And that's the structural model. Are we then applying wrong rules to a wrong entity? Can we apply the rules that we were applying to commercial banks to an entity like IL&FS?
So, Supriya, I think Maithili's really nailed the issue. The question is, this country needs a lot of infrastructure. How are we going to finance it? The commercial banks are completely unsuited to finance long-term infrastructure projects, and that is the reason we have this massive NPA problem. I'm discounting the frauds and the crony corruption and all of that. I'm saying in the infrastructure sector, the commercial banks are not the right institutions. If you remember, in the days when we started banking 20, 30 years ago, it was ICICI, IDBI and IFCI, which were the long-term development financial institutions which had long-term sources of funding and who had people who were trained to investigate and understand the risks associated with long-term project finance. Those people, those institutions have changed. They've become commercial banks. They've changed their nature. And we don't really have either a body of people or a set of institutions which knows and understands the risks associated with project finance. However, Supriya, we do have long-term sources of funding in this country. We have pension funds, we have provident funds, we have savers who want fixed long-term security in terms of lending their hard-earned savings. Today, if a saver wants to put their money in a bank, you really don't know what interest rate you're getting. Are you getting 6%? Are you getting 7%? Is it going to beat the inflation rate? Ideally, we need to match long-term savings with long-term lending. There is a great appetite for long-term savings in this country. I remember, I don't know whether you do, there was the Konkan Railway which floated bonds, and they floated long-term bonds with an interest rate of 12 or 13%. They were dramatically oversubscribed. So there is an appetite for long-term financial instruments in this country. The problem is the government doesn't see that. They are forcing commercial banks to lend to these things. They're forcing institutions which are pass-through institutions like IL&FS to do this.
Right.
And we have lost the body of expertise of people who understand what are the project risks associated with these long-term, these infrastructure projects. So it's a recipe for disaster. I mean, this to me is the tip of the iceberg. We are going to see many more of this kind of, situations arising.
I think both you and Maithili are completely nailing the issue, because infrastructure lending cannot be done by commercial banks who are also in the retail space, who are also doing some sort of corporate lending. They cannot be the infrastructure lending institutions of the country. But Lakshmi, I will quickly get you on this before I take that very short break. There are wider concerns that the impact of this may spill over into the infrastructure industry, pushing up funding costs, and may even put brakes on some projects. That's going to be the ripple effect, the impact of what's really happening at IL&FS. My question to you really is that should the regulator or should the government at this point in time mull over separate NPA categorization norms for infra projects which require long gestation periods? I mean, there is one thing to say that, we need to have separate lending institutions to them who understand these projects, because these are long gestation periods, their troubles are different, their bottlenecks are different. But should there also be a different NPA categorization for them? And is that where the debate and the discourse needs to move towards? Lakshmi.
No, so clearly, I agree with what Meera and Maithili said. What is happening is that whether it's a commercial bank doing its normal lending operations, or it is an infrastructure kind of an entity like IL&FS and several others who are doing long-term gestation projects, the source of financing those, among other sources, are also capital markets. And capital markets also includes mutual funds apart from provident funds and insurance companies. So I think carving out these entities and having maybe slightly different provisioning norms, I don't know how, in what form and shape it should materialize. I don't have really concrete thoughts on it right now, but I think it will definitely help to provide I think the first problem here is provide them a more durable source of funding, so that they don't access short-term markets to fund, probably part of it of course, to fund long-term asset projects that they are into. And then the second level obviously would be, if you are carving out a separate source of funding pattern for them, also have a different norm for their own NPA recognition, because the kind of business they are into, something like this going bad, obviously not overnight, is bound to happen. So I think on both those counts, I believe once the dust settles down, there is a case to relook at this entire thing and see if something specifically can be done for this category.
Okay, hold that thought, because I think I'll take a really quick breather on that note. This is a fascinating discussion. We're at least putting some solutions to the table. This isn't just blame game that's happening, and this is a fascinating panel that's giving us those ideas. Just stay with us as we discuss a very important subject. This has been under the radar for very long, but it will not be. This is going to impact your investments. This is going to impact how markets move. This may also eventually impact how lending happens in this country. So just stay with us. We'll take a really quick breather, and we are back in just a moment right here on the India Development Debate. So good to be back with you once again on the India development debate right here on ET. Now we're putting the spotlight on IL&FS and why its contagion could matter a lot. Mr. Mukherjee, if I may come to you, initially the authorities, and initially I remember the statements that were coming in from the finance ministry, at least the economic affairs secretary Subhash Chandra Garg saying that IL&FS is independent of government, the government is not involved directly. Initially, it seemed that the government was washing its hands of the IL&FS mess. But can a government afford to do that? I mean, even now they are off the record telling you we'll wait and watch what happens. It's up to LIC. Can they afford to do that? And are they being a tad too reckless? Will they ever allow this to happen to a real bank? Because, and is it convenient to say so? Because IL&FS doesn't take deposits like a bank does. So it's easy for a government to say, it's none of our business. It's a private entity.
Yep. So yeah, that's true. So in India, we've not even had smallish banks like Bank of Rajasthan or Global Trust Bank allowed to go down. And I doubt whether there is any intention on the part of policymakers to let IL&FS go down either, because the systemic risks are far too high. While it's not India's Lehman moment by far, but still the systemic risks should the institution go down will be far too high, far too disruptive, and at a moment where there is a significant amount of global uncertainty around a variety of factors, interest rates, dollar swaps, oil prices, trade wars, etc. going on. So obviously from a macro standpoint, we can't afford it. I don't think the real intention of policymakers is also to ignore the problem and let it fester. So absolutely not. They will find a solution. The process has already started, and I'm pretty sure a solution will be found. Just a point though on the funding structure that got discussed previously. Actually, banks make money by lending long and borrowing short. If we are to match fund every asset with a liability, there will be very little margin left for any lending institution. So to say that just because somebody is funding infrastructure, it has to be matched funded with long-term sources of funding, I think that's not the real issue. The real issues are to do more with supervision, with risk management, board governance, and all of the above. So yeah, but at the end of the day, systemic risks are high. It is for good reason. It is termed as a systemically important institution, and a solution will be found.
Fair point. Okay. All right. Just hold that thought, because that's another argument to be made as far as that long-term lending is concerned. But Mr. Gupta, IL&FS may not be taking deposits like a bank does, but it is extremely important to money markets, because it is IL&FS-like cases that cause liquidity shortage for NBFCs. And these NBFCs don't borrow via sticky deposits. They are dependent on market liquidity. And if that shrinks, their operations are hit hard. There can be no denying that. And which is why the fear of this domino effect, which is why the fear of our markets moving on rumors of a liquidity crunch. I mean, even with sound fundamentals, we could see a domino effect come into play.
Supriya, you understand, the market does not work on fundamentals alone, it works more on a sentiment basis. Now here the sentiment has turned negative, and other thing is the IL&FS may not be taking any deposits from anybody, but what is happening, the mutual funds are invested in, other NBFCs are invested in, they have taken a deposit, mutual fund have taken money from the investors. So somewhere there is going to be contagion effect, because if mutual funds is not able to liquidate its investment from IL&FS, it has to liquidate some investment somewhere else. So ultimately it is going to boil down to the liquidity and how the liquidity is managed, and how soon the sentiment which has turned negative about NBFCs and such issues are taken care of. Coming about this, everybody is talking about the long-term and short-term funding. See, RBI does not allow anybody to borrow for more than 10 years. That is one important. The other thing is that when ICICI and IDBI used to be the long-term lending institution, they also never lent beyond 10 years. And such projects which are being done by IL&FS were not there in 80s and 90s. It is of a new generation. So we have gone ahead with financing of infrastructure project without creating a proper framework for that. That is one of the most important things. And again, I would say that as soon as the sentiment is taken care of, probably we'll be out of this.
Okay, so this is not just a macro situation, this is not just a fundamental situation, this is also the sentiment at play. But Ms. Sanyal, I think we need to talk about the plans of selling assets. IL&FS has saleable assets. There are about 25 to 26 asset blocks that can be put for sale. But isn't there a risk that to tide over this crisis, we may run the risk of doing a distress sale, especially if you put all these assets on the block all at once?
So I think, Supriya, it's quite interesting. I mean, if you look at the structure of IL&FS, it is not only just a financing and leasing company, it's also an operator of many of these things. For example, they are building roads, they're actually going into the construction and operation of infrastructure, Gurgaon Metro, etc. So it's a very strange animal that we have here. And once again, the question needs to be raised as to actually what was the mandate of IL&FS and what did the board want it to do and what did the shareholders want it to do. So some of the assets which I imagine would be put up for sale are these extraneous things. I mean, there has been certainly a mission creep as far as IL&FS is concerned if you look at its original charter. I would say it's a good idea to sell some of these non-core assets. They don't have to be distress sales. They could be people who are better suited to building and operating these kind of infrastructure assets, and they should actually get them. I think it's also interesting now that the government has made statements that it is a private company. There has been information in the public domain that Oryx of Japan, which is one of the major shareholders of this company, is interested in taking on a majority stake. Well, this is going to be a test of the intent of the government. If they are truly serious about minimum government and maximum governance. We haven't seen that apply in many of the other PSU organizations, whether it's oil companies or banks. But IL&FS could be a very good example. Let Oryx take over IL&FS and let's see how that shapes out. That could be a very good resolution to this problem.
Okay, we'll also test the minimum government, maximum governance diktat there, and that's a fair point indeed. But Lakshmi Iyer, can NCLT, and that's the real talk, I mean, we are putting stories out here on ET now as well that the government is looking to do that. Can NCLT resolve a case like IL&FS? Because NCLT extracts value of a debtor's assets. Now, how different will resolution be and how big a moral hazard will it be? For this to happen? I'm just curious to understand, will a case like IL&FS fit the bill for an NCLT to extract value out of?
No, I think, NCLT is a last ditch attempt, so there is a lot more that needs to be done, which I also believe, as I also read the news quoted on media, that a lot is being done, including monetization of monetizing their existing assets, sale of the building, etc. And if you see broadly out of their existing 25 odd projects, what we also get to hear, obviously reading from media, that the immediate on sale projects available are close to about 14-15 in nature, which will raise about $1 billion plus. So I think while it is good to think of the inevitable and think about the last mile, there is some book associated with this entity because it is a culmination of various subsidiaries and SPVs that go into the making of IL&FS. So I think what is important is that you get to the core of it and try to resolve this rather than contemplating that, because that could have far-reaching repercussions from an industry standpoint. And as someone rightly observed, that it's very critical that it is not just about fundamental or regulatory, it is also about the sentiment that will flow through if an eventuality like this were to occur, whether it is from the ultimate retail investor, because mind you, there is also a retail coterie apart from mutual funds. Mutual funds are a smaller issue. They are holding less than $1 billion of total in this lakh crore plus of debt outstanding. But there are also HNIs and retail investors who are holding holding pref shares, bonds, etc. So there could be far-reaching implications. So I don't think it is going to be a straightforward thing, to look at NCLT as a resolution to this problem. But there is the step A, B, and C that needs to be done, which I believe is a step in the right direction to be able to get out of this issue.
Just hold that thought. I'll take a quick word from Ms. Sanyal and then a last word with Maithili. And Ms. Sanyal, please make this a little brief. On September 28th, we'll have RBI that will meet IL&FS's, we'll have India's central bank will meet IL&FS shareholders to talk about the set of defaults, discuss capital infusion plans, and of course, shareholders will take that up on the company's AGM on the 29th. What do you expect to transpire between those 2 days, and what is perhaps going to be the way forward? Because, I mean, Lakshmi is right in saying that NCLT perhaps should be the last resort, because we perhaps could end up seeing significant asset value erosion. We need to tap other resources first.
Well, I think Lakshmi is absolutely right. I mean, we would imagine that you should really go for liquidation in the last event, and I don't believe that IL&FS is in that state as yet. But as I said, I would welcome seeing more shareholder involvement from some of the big shareholders. Not LIC, I would urge, because LIC is putting its finger into too many distressed assets. But if Oryx wants to come in, why not? I think it would be very good if the RBI were to welcome them in and indeed get rid of the non-core assets. I mean, there's a lot of stuff on IL&FS's books which should not be there and which should be divested. And I think they should get to doing that quite seriously.
Okay. Quick last word to you then, Maithili. And PSU bankers have been at the receiving end. The narrative is all about how India's public sector lending is so rotten. How do companies like IL&FS get away with blatant corporate misgovernance, regulatory oversight, complete lack of accountability by the CEO, by the board, by the ratings agencies? It does raise many questions of how sound our private sector, companies also are. It's very easy to raise fingers and make, scapegoats sometimes, I believe, out of public sector lenders.
Oh yes, I would agree with you entirely over there. Public sector bankers are everybody's favorite whipping boy. They're soft targets, they don't know how to retaliate, whereas you have a lot of blue-eyed boys and girls in finance, and they're able to get away scot-free without any questions being asked. In fact, the entire issue of whether you need separate NPA norms for infrastructure finance, in fact, RBI's February 12th circular puts it very squarely. They say RBI is not willing to look at different NPA norms or any kind of relaxation, even in the case of the stress assets in the power sector, for instance, or any other infrastructure area. So clearly there are, as I said, there are financiers and there are bankers, and the rules are not the same for everybody. It's time we use this opportunity to set the house right completely and address all the fault lines that we have in the financial sector, regulators, rating agencies, auditors, most importantly corporate boards, and at the same time do something about ensuring that infrastructure financing is done in a sustainable, efficient manner, and government also plays its part, because many of these cases, because government companies do not pay their dues to these infrastructure companies. So combination of factors, and we need to use this crisis to address all these issues, Supriya.
Okay, on that note, completely out of time here. Thank you very, very much, Mr. Mukherjee, Lakshmi Iyer, Maithili Basturmat, Meera Sanyal, and of course, Mr. Jayan Gupta for being with us. This really has been a fascinating discussion. I ended up learning a lot more about IL&FS and the solutions that can be put forward to the table, and why does one need to sit up and take note of what's really happening with this particular corporate. But remember, LIC, SBI and the Central Bank of India together hold almost 39.5% stake in IL&FS. Wonder what was really happening at the regulatory level, at the board level, and of course at the management level. But thanks very much for being with us on this edition of the India Development Debate.